Let's talk about investment mistakes, specifically through the lens of Warren Buffett, one of the most successful investors of all time. You know, it's easy to look at Buffett and think he's got it all figured out. I mean, the man has built a fortune that many of us can only dream of. But what's often overlooked is the fact that even Buffett has made his fair share of mistakes. In his journey, he's encountered pitfalls that have taught him invaluable lessons, and it's these lessons that can help us all become better investors. First off, let's acknowledge that investing isn't just about picking the right stocks or timing the market perfectly. It's a complex game that requires a deep understanding of risk and a clear strategy. Buffett's approach has always been rooted in value investing, which means he looks for companies that are undervalued compared to their intrinsic worth. But here's the kicker. Even the best value investors can misjudge a company's true value. One of Buffett's early mistakes was investing in a textile company called Berkshire Hathaway. He bought it at a price he thought was a bargain, only to realize later that the business model was outdated and the industry was in decline. This taught him that sometimes even a great price doesn't mean a great investment. Now, let's pivot to the importance of understanding the business behind the numbers. Buffett famously said that he only invests in companies that he understands. But there was a time when he ventured into industries that were outside his expertise. He invested in a company called Dexter Shoe, which at the time seemed promising. However, he didn't fully grasp the competitive landscape and the changing consumer preferences. The result? A massive loss that he later referred to as one of his worst investments. This experience reinforced his belief that you should never invest in a business you don't understand. It's a lesson that resonates with many of us. We often get tempted by trends or the latest hot stock without truly understanding what drives its success. Then there's the issue of emotional decision-making. Buffett has always emphasized the need for discipline in investing. He talks about the importance of staying rational, especially when the market is volatile. Yet, even he has had moments where emotions clouded his judgment. During the dot-com bubble, he avoided technology stocks because he believed they were overvalued. While he was right in the long run, it was tough for him to watch others make enormous profits while he played it safe. This taught him that sometimes sticking to your principles can feel lonely, but it's essential for long-term success. It's a reminder that we all face the pressure to follow the crowd, especially in a world fueled by social media and instant information. Let's not forget about the power of patience. Buffett is known for his long-term investment philosophy, but this doesn't mean he's immune to impatience. There were times when he held on to stocks that he believed would eventually pay off, but took longer than expected. One of his notable investments was Coca-Cola. He invested billions in the company during the early 1980s, and while it eventually paid off, there were moments of doubt. The lesson here is that good things often take time. In our fast-paced world, we want instant gratification, but investing is a game of patience. Learning to wait for the right moment can lead to significant rewards. Now, let's talk about diversification, or rather, the lack of it. Buffett is famous for his concentrated portfolio. He believes in putting a significant amount of money into a few companies he trusts, rather than spreading himself too thin across many investments. However, this strategy comes with its own risks. He's faced periods where a downturn in one of his major holdings, like American Express or Coca-Cola, could have derailed his entire portfolio. While he has the confidence and knowledge to back this strategy, it's a reminder that diversification can protect us from unforeseen downturns. For many of us, a balanced approach might be more suitable, especially if we're still learning the ropes. Another critical lesson from Buffett's journey is the importance of continuous learning. He spends hours reading every day, absorbing information about businesses, industries, and economic trends. Yet, even with all his knowledge, he has made mistakes. He once invested in a company called U.S. Air, which struggled due to the cyclical nature of the airline industry. This experience highlighted that no matter how much you know, you must remain adaptable and willing to learn from your failures. It's a humbling reminder that the market is always evolving, and so should our strategies. Lastly, let's touch on the significance of ethical investing. Buffett has always maintained a strong moral compass in his investments. He avoids companies that don't align with his values, even if they promise high returns. This principle has guided him through tough decisions, ensuring that his wealth is built on a foundation of integrity. In a world where it's easy to chase profits at any cost, Buffett's approach reminds us that our investments should reflect our values. It's a lesson that resonates deeply, especially as more investors seek to make a positive impact through their financial choices. In conclusion, Warren Buffett's investment journey is a treasure trove of lessons, not just about what to do, but also about what not to do. His mistakes serve as a reminder that even the best can falter, but it's how we learn from those missteps that truly defines our success. As we navigate our own investment paths, let's embrace the wisdom he's shared, stay disciplined, and remember that building enduring wealth is a marathon, not a sprint. Each mistake is an opportunity for growth, and each lesson learned is a step closer to mastering the art of investing. So, let's take these insights to heart and approach our financial journeys with a blend of caution, knowledge, and a willingness to learn.